Alright guys, what's up? It's Pac. Welcome to video 4, price narratives and price expectations. Now, buckle up, this is probably going to be the most important video in this entire series that I'm doing, because if we don't understand price narratives and price expectations, then it is very, very likely that we're going to get smoked because we don't know what price is actually doing. Okay, you'll see all over my Twitter, people ask me, why'd you take this trade? Why'd you take that trade? Why'd you do this, XYZ? Again, it all comes down to my price expectation and my price narratives. And so there's three simple expectation models that I am going to go through in this video that I highly recommend that you backtest endlessly because you're going to see that they happen quite often. And we're also going to discuss where narrative actually comes from, and then those price expectation models and where price expectations come from. So, further ado, video 4. All right, first off, we're going to talk about everybody's favorite thing is narrative. And how do you generate a narrative? Well, generating a narrative is very simple. The way I was taught it is, where did price come from and what is it reaching into? Where did price come from and what is it reaching into? Where did price come from and where is it reaching into? Where did price come from and where is it reaching into? Okay, so keep that in mind. Where did price come from and where are we reaching into? So for example, if we have price trading down and we're here in this downtrend and we see something down here that leads us to believe that we might have a pullback or a reversal occurring at this area. One thing I ask myself is, where did this point in price come from? Well, it came from this high, right? Okay. Well, is it reaching into anything that may have occurred down here? Or is it going towards anything that may have occurred down lower? If the answer is yes, there's some point right here that it's reaching into based on my back testing, then even if I see something that might indicate bullishness or bearishness depending on the situation, but bullishness in this situation, I'm going to wait until it hits that specific spot that I've seen in back testing. Why? Because of where it came from and where it's reaching into. Where it came from and where it's reaching into. Because once those two things are complete, where it came from, we know that, and it's hit where it's reaching into, the narrative will now switch. So say it had to reach into something that was here, and we see some sort of bullishness occur. Well, now, where is it coming from, and what is it reaching back into? Very simply, in this model, it'd be reaching back in to where it had previously came from. And that's how price typically moves, is it'll go from one area, and it'll go to another area, and then inside here it left an area, so price will come trade down into this area, and then it'll go to another area and it'll trade back down here, and then it'll go to another area, and then it'll do something like this, and then it'll trade back down into an area left behind like we talked about in previous videos, and then it'll trade up to an area here, and then it'll end up breaking here because there's another area back down here that it needs to go to. So narrative is very basically built on that one thing. Where is it coming from and what is it reaching into? The only way to identify price narratives is through what I call price discovery. And I've talked about this on my Twitter quite a bit. And y'all asked me to touch on this. What is price discovery? Price discovery is very simply me watching a historical data chart without marking a single thing up and just watching, why did it bounce there? Okay, well, we hit this area that looks like it might be important. Where do I expect it to go next? Where is it reaching into now? Where did it come from? Did it come from a high? Did it come from a low? Did it take something? What is it reaching into? And that's all going to be done through, you guessed it, backtesting. But those are the basics of your narrative. If you can always remember where is it coming from and what is it reaching into, you're going to be on the right side of a lot of trades. Now, here's a pro tip. A lot of people, and I don't necessarily believe this, I don't necessarily believe it's wrong either, it's just not something I look for. They'll have price like this coming down, or it went up and now it's coming back down, and they will simply say, oh, price is reaching to take this low. I am never personally looking for price to take lows and highs. I'm only looking for price to reach into areas and continue structure that it has on the macro. So I don't necessarily believe that you have to come take any source of higher, lower liquidity or whatever you call it. I simply just believe it's reaching into an area. So yeah, some people say, oh, swept liquidity. Cool, great. That's just not how I see it. I see us coming from a high, reaching into an unmitigated area down here, and that should expect to continue structure to the upside. So what are my three models for price expectations? Here's my three price expectation models. And they're very, very simple. And one happens significantly more than the other. So here's our first model. And I always draw it from this because I typically take bullish trades. There. Our second model is going to look like this. And our third model is going to look like this. And let me complete this second model here and you'll understand. Okay. So these are our three models that I'm typically looking at. Model number one. You have to understand that this model happens almost 70% of the time. Okay. This is the model that happens almost 70% of the time in price. These other two combine for the other 30%. Okay. So what are these three models? Well, the first model is you have a high. We traded down. And let's say this is, we're expecting bullishness, right? It'll be the opposite if we're expecting bearishness. We'll trade up. We will get close to this. We will trade away, and then we'll go take the high. Okay? So this will occur a lot of times at high time frame highs. I use the 12-minute at hourly highs, at your higher time frame zones. Okay, so what's the expectation when we trade up into close to the high is that there's going to be a move away from the high. So I know the next move because this is the price expectation, and all of these have the same price expectation no matter what. There's a short in this area and then a long in the long scenario on all three of these situations. So I can always expect that short to be there somewhere. The second model is we have a high and we trade up to it and we wick through it, but we fail to close. Well, once we fail to close, that is a what? Double top, and our expectation is that price starts trading down towards the bottom that brought the high, the inside low that brought the two highs. So again, same as the first model, if it wicks through it and fails to close, we're expecting a trade back down into the range. So there's a short there. And then the last model, very simply, is we trade up above that high and we close. Well, at some point, we're still expecting a move back down here. Why? If you watch video 3, to mitigate the previous swing point. So in all three of these models, no matter what price decides to do, there's always a short coming out of it. Same thing if I go to the long side. If we look at the long side, it all looks the same. It'll come here and then it'll go take. Or it'll come here, it'll wick, and it'll come down. Draw a little wick here. Excuse me. And then lastly, it closes the low. We're still expecting a trade back in. So when these happens, when we approach these highs and lows, whether they're structure or non-structure, you'll see these three price models all play out. So a lot of people will say, oh, it looks like counter trend. You're very, very correct. This is a counter trend trade, but we're expecting that move. So it doesn't matter if it's counter trend trade because we know that in all three of these moves, they're going to go reach back into something and then produce that next leg whether it comes and takes the high or not. Same thing on the short side. It'll come, reach back into something, and then produce a long. So now we know the next two moves in these price expectations. And if I know the next two moves in the price expectations, I can get involved in a lot of trades. So this is what I'm always thinking about while I'm trading, is these models that present themselves over and over and over and over and over. So let's look at a few examples. Okay. So the first model we're going to look at is my favorite model, the one that happens most often, is where it comes down, it trades towards, it trades away, and then it comes and takes the high. Now, I'm sure right when I drew this, you're like, oh, I see it right here, right? We trade down, we approached the high, we tapped into something, we traded away, and then we came and took the high. Okay? It does the same thing when it approaches it again. See that? It comes down, it taps into something, it goes and takes the high. Okay, that's great, Pac. Sweet. Awesome. I'm so glad you could point that one thing out to us. But it doesn't happen all the time. Even on smaller points, does it? Let's find out. Here's a high, a low. It trades up towards it, trades away, goes and takes. Same model. Let's see it happen again. It trades down, it trades up, trades away, goes takes. Crazy. Let's see it happen again. We have a high, we trade up, we trade, this one wicks, it comes down, but then it goes and takes. So that would be the second scenario. Here's another scenario, right? It's here, it's down, it's up towards the high, it trades away, and it goes and takes. Okay, let's see what about on the short side, right? What about when we're looking at shorts? Let's see if we got one. Oh, here's one right here. Here, trades up, trades towards that low, trades away, takes. Crazy, right? It's a crazy things that happen all over the place. They happen all over the place. Let's see it on a higher time frame. Let's see if it works on a higher time frame, right? Let me go to the 12-minute. Here we are. We traded down, we traded up towards, we traded away, and then it comes and takes, right? Comes and takes. And if you want an even higher time frame, we traded down, we traded up towards, we traded away, and then it goes and takes, right? That's the model that we like to see quite often form. Why? Why is that the #1 model? Well, the reason I like that model is because I know where I can start expecting a difference in order flow to start occurring. Let's see another example. We have a short side here. Here, trades down. We trade up. We're coming back down to try to take this low, right? It gets near it, trades away, comes and takes. Right? Same thing here. We trade down, trade up. We come try to take that low, we trade away, and we take. So that's the very basics of the first model. What about the second model? The one where we talk about it wicks, right? This is the second model. Here, trade back down with a wick. Okay, let's see it happen. Here it is right here, right in front of our eyes. We have a high, we have a low. It fails to take the high, it wicks here, right? We very clearly see that wick, and then we come short all the way down at that low. Same thing here. We have a high, we try to wick it, we fail to close above that internal high, and we trade down, take out the low. Let's see if we can find some more. Let's see. That one ends up closing. Here's one. It's going to be a wick on a higher time frame, but this will be like a 144, but it's the same thing. We have that low. We come down, we wick it, we go take the high. Same thing on the upside, right? It has that high, it comes and wicks it, it attempts to go take the low. Fails up to the other side. if we go to the 144 minute, this is something that happened last week. That while I was expecting these lows to come get ran right here. Because last week, I believe it was last week, yep, Friday the 8th, is we had a high, we traded down, we came and wicked it, we were expecting these lows to get ran, they finally did right there. Very, very, very simple. And then where's our third? Where's our third model? Our third model, if you'll remember, going back down to 12 minute, just so it's easier to see. And there's very clearly one that just formed here. Our third model is trade down, continue structure, trade back into the range. What do we have here? A high, a low. Takes the high, trade back into the range. Cool. Here's another one, even lower down. A high, a low, takes the high, trades back into the range, continues. Let's see another one. Right, let's see. Right here. This is a good one. Even this can be considered the wicked one too, but here it closes, we trade back into the range. Here's another one. Low, high, closes, trades back into the range. Here's another one, even if it's a wicked one, whichever one you're seeing, trades back into the range. Here's another one to the upside. Boom, boom, trades back into the range. Here's one here. Boom, boom, takes it, trades back into the range. So the key here is if I know that these are my price expectations, right? Low, takes it, trades back into the range. If I know that's my price expectations, I don't have to wait for a potential long. I know how to figure out to get involved in the short side to potentially, if it gives it to me, another long side and vice versa. So those are my three price expectation models. So don't take my word for it. I would really, really, really advise you to go test these out yourselves, those three price expectation models. And then you couple that with zones that are unmitigated, you start to be able to formulate areas that you'll bounce, that you'll be able to find where things might happen. For a very good example is here today on this price action. So we had that low, we came up, we closed. Where does the bounce to the short side end up occurring? Well, it very simply starts occurring in this zone that hadn't been mitigated at least 50%. So when we start putting the price expectation models together with your swing points and your unmitigated swing points and those price expectations, you start generating ideas, and you'll very quickly see in backtesting that it lines up with a lot of the bounces and reversals and pullbacks that start to occur, especially on the higher time frame. Well, how can we use it on the lower time frame? For example, if I go down to the 1 minute, same thing here. Say my price expectation was, hey, after we close this low, because I know that even if we close this low and shift bearish, there's a price expectation that it will trade back into something that's left unmitigated. And you very clearly can see that this swing point, which is our last swing point to the upside, it hit 50%. So, okay, cool. If we trade down and we start trading up and we do break something down here, we can expect it probably to run that high. But again, what's the price expectation model that happens most often? This bad boy. So if I know there's longs underneath here because we broke it and we know that what's the next move? The move back into the range. If we break, we know there's a move back into the range. Well, once I get my entry model, which in this scenario, if I was looking at this time frame, it would occur somewhere where my entry would be somewhere in this area. Let's say I was going long from this area here and I was covering my shorts. Well, very simply, I'm not expecting, hey, price to just go take the high automatically. I'm just taking something that I know for a fact is going to get taken first before the reaction and the price expectation plays out of this. So I'm taking this somewhere, which we'll go over in later videos, but this is how I can get involved in this move, even though it technically broke a structure on the 1 minute to the downside, right? Because we shifted. I know that the move was back in there. It's the same thing that if you go back to my Twitter, I actually have a picture of this marked out. It's the same thing that happened here. You'll see a picture that I have that has this like this, and I have some entries in here. And then I have a line going like this, and then I have price going like this, and then going like that. Well, it's the same model, right? If we take this low, we're trading back into the range. Now, did I know, based on what I was looking at that time, that we were going to run all the way up here? No, but I don't need to know that. I only need to know enough to catch the points that I'm looking for. And just this run up alone is 62 points. 62 points is pretty damn good. I would say so. So go back to these three models, rewind the video, screenshot those three models. You're going to want them. Couple those with the previous video. Go rewatch that of unmitigations. And if you don't know how to find the zones, watch video 2. And if you don't know how to find those zones, watch video 1 again. But these 4 videos alone, market structure, your swing point video, how to mark out the zones, your unmitigated zones, and your price expectation models, this right here is going to change your trading. Let's go to video 5.